So let's start the profitable world of fixed income securities. A lot of us are more interested into equity markets and find it very dynamic, but this is an uncharted territory for India actually. And we'll discuss more about fixed income securities and how we can actually make use of it. So basically, if you have a look at the debt markets and compare it to the equity markets, you'll find that the debt market is it occupies a bigger chunk of the asset class in size. And from an investor point of view, it not only provides a potentially stable and reliable source of income, but it also provides a very good opportunity to diversify your portfolio. Diversify in the sense you are not concentrated into one particular asset class. It actually helps you when there is a stress in particular market, you can utilize and make hay in the other capital market, which is the fixed income security. So basically, our course plan is designed as such. We'll be discussing more on the basics of bonds, the risks involved in bonds, the types of bonds, and the Indian bond market, which is where we belong to, and how we can make full use of it. So this is a very brief outline about what is the source of funds. Basically, we all know in order to start a business, we need funds. Now, there can be two sources of funds. One can be the debt, and the other can be equity. Now, let's have a small description about what are they actually about. In case of debt, there is no ownership stake, or you don't have any voting right. You just act as a lender to the company. So what you get is the interest on debt, and it is actually the cost of the business for the company, because it is actually paying for the funds in terms of the interest. And it is considered more senior because you have a direct legal recourse on the debt. You can actually seize the assets of the company if the company is not able to meet its obligations. But equity is quite different from debt. In case of equity, you get an ownership stake as well as a voting right. Voting right in the sense, if suppose the company, the management feels that they'll come out with some decision of change in some management, or want to change some part of the business, then you have a voting right. You can veto, or you can agree to the decision. So you are actually taking part in the business. So that is one of the benefits of being an equity holder of a company. Secondly, as we saw that in debt, the company is liable to pay the interest. But in case of equity, there is dividends which the company has to pay, and it is not necessary that he has to pay the dividend. And so there is no legal recourse for the stockholders if the dividends are not declared. So equity is always junior to debt. So now let's see what is fixed income or debt security. If we see in the general terms, there are two basically aspects of a debt. One is the borrower or the issuer, and secondly, there is the lender or the investor. So thanks Elon Markets. I'll raise my voice. Yeah. So now we'll discuss some of the terms of a bond. What are the different aspects we should know about a bond? First of all, it is the face value. Face value is what amount of money you will be getting at the time of maturity. That is, you invest 100, are you going to get 100 at the end of the maturity, that is after 10 years, or you will get something more or less than that. First and foremost is the par or the face value. Secondly, as I said, the maturity period, which is also called the tenure for the debt instrument. And thirdly, which is a very important aspect of bond, which is called the coupon. This is basically the interest yearly or periodical interest which you will be getting on the investment you have made, and this is always calculated on the face value of the bond. Fourthly, this is the interest payments, which is also called the coupon frequency, which is the time interval after which you will be receiving the coupon payments. So it can be yearly or semi-annually, or it can even be monthly. So this is called the coupon frequency. And finally, it is the purchase amount, which is the price at which you are buying the bond. It is similar to what you buy for a security, for an equity security. So suppose your SBI is trading at 300, that is the purchase price for SBI equity. Similarly, if a bond is trading at 102 rupees, that is the purchase price for that bond. So I'm just giving a small example for this. Suppose A borrows rupees 100 from B for 10 years at an interest rate of 9% to be payable annually. What we are seeing here is the face value is rupees 100 and the tenure is 10 years, and the coupon interest which is payable is 9%, and the coupon frequency is annually. So it is self-explanatory. All the terms are being explained in this. Only the purchase amount is not explained. We'll come to it in the next slides. So one basic notion which people are confused about is the coupon is actually the return which they are generating by investing in a bond, but that is not the case. It is actually the yield which is the return an investor will be generating by investing in a bond. So the most important aspect when you go for an investment in a fixed income security is return. Hi Kokan, just a moment. Yeah, am I audible now, Kokan? Yeah. Sorry. So yeah. So do you want me to start from the first slide again? Elan Markets and Kokan? No, it's okay. Thank you. So here what we see is the purchase price will actually determine what return you'll be generating by investing in a bond security. So if you blindly go and invest, by looking at the coupon rate provided by a security, I feel that's not the correct inference you are taking by investing in a bond. The most important thing is by looking at the purchase price and seeing what yield you'll be generating by holding it till the maturity. So this is a very important concept, and the yield can be calculated by different methods. The yield you can calculate, the most famous method is the cash flow method, where we actually which is actually the internal rate of return which the bond is generating for your investment, wherein you actually equate the initial outflow with the inflows you'll be generating over the period of time, and that is actually you actually to the present value of the inflows you'll be getting during the course of time and the current outflow you are making by investing in that bond. So suppose you are purchasing a bond at 102 rupees, which is having a coupon of 9%, which is payable annually during the course of 10 years, then each year you are getting 9 rupees as an interest, and at the end of maturity, that is after 10 years, you'll be getting the face value, which is 100. So what here we do is 102 is the initial outgo, that is equated with the inflows you'll be generating every year. So 9 divided by 1 plus R, where R is assumed to be the yield. So 9 divided by 1 plus R plus 9 divided by 1 plus R square, so on till 9 divided by 1 plus R to the power of 10 plus 100. This is equated with the initial outgo, which is 102. From there we can get the value of R, which is actually the yield we are generating by investing in that debt security. So this is the return which you are generating from the bond investment is more important than the coupon at which you are investing in a bond. So if a bond is providing you a coupon of 11%, but it is available in the market at suppose 120 rupees, and you compare it with a bond which is providing you a 9% coupon rate and is only available at suppose 90 rupees, then you'll find that the return provided by the second bond will be higher than the first bond, even though the coupon rate for the first bond is higher. So this is how we find the importance of yield for the bond investment. So when you actually look at various terminals for bond securities, you can go to bonds traded bricks online bonds traded today, or you can go to CCIL India for government securities. You'll always see that the purchase price is given, the price at which the bond is available in the market, and beside that the yield is given because of the importance of the term yield. Secondly, another important concept is the risk. In whatever securities we invest, risk is one of the most important criteria. There is always an inherent risk involved in any security available in the market. So our aim should be to generate the highest risk adjusted return. Are we getting enough returns by generating in a security which has a particular amount of risk? That should be our aim. So if you invest in a very low risk security at a high yield, and you invest in a very high risky security at the same yield, it is better to go for the first one because you are exposed to lower amount of risk.